Adam Myers and I lead the distribution team at Pengana. Thanks for joining us for this webinar update with Ed Prendergast, the co-portfolio manager of the Pengana Emerging Companies Fund. Yesterday, the Emerging Companies Fund had its annual review meeting with one of the research houses. And the first question that was asked was, have there been any changes to the process since the last meeting? Ed immediately replied no, and as the conversation continued, it became clear that there have been no changes to the process since it was incepted, since the fund was incepted 17 years ago. So investors in the fund really know exactly what they are getting, and that consistency has been the backbone of their long-term outperformance. During Ed's presentation, if you have any questions, please enter them in the question box, which is accessed from the icon on the bottom of your screen, and we'll get to as many as possible of them in Q&A at the end. Ed, over to you.
Thank you, Adam, and thank you everyone for joining us this morning. We'll run through a few things. We'll give you a quick update on the Pengana business, the fund. We won't sort of dwell on that for too long because, as Adam just said, nothing really has changed. What does change is markets and stock prices and our assessment of the upside and all those sorts of things. And that's where we'll spend most of our time. So we'll talk about our recent performance, both last calendar year and in the last 3 months, which have obviously been fairly interesting to say the least. And then we'll talk about how the portfolio is positioned, what we kind of like, where we're sitting, and equally we'll pull out 2 or 3 or 4 or 5 stock stories actually. And that often just gets the juices flowing as to questions and the like. So as Adam said, more questions the better, but I'll fire away. If I just get the right button here. So here's a summary, just sort of reminding people for those who are less familiar with the fund, what we've been doing for the last 17 years. And as Adam said, nothing's changed. It's the same 2 fund managers. So Steve Black and myself formed the business in 2004. We don't have staff below us. We don't have an investment team. We make all of the investment decisions ourselves. We don't use external research for valuations. We do everything. We visit the companies and we visit a lot of them. And because our investment process is very much slow and steady, we buy things that we really want to own for 2 to 5 years. Then we're not frantically trading. We're not looking at share prices all day, every day. A lot of people who do what we do a lot of short-term stuff, and that is very, very high touch. And ours is not. Ours is very considered, slow decision-making, making sure that we spend the time and find, as I said, stocks that we can hold for a long, long time because we think they're well managed. They've got a different a point of differentiation, and they can grow over a long period of time without us having to stress too much about their weekly cash flows. So the team hasn't changed, the process hasn't changed. We don't invest in resources, we don't invest in speculative stocks, and we're largely closed to new investors. So, and that's a key plank of what we do. Make sure the fund doesn't get too big. There's a few summary points in here which we'll drill into in more detail soon. The performance, we'll get to a broader table in a second, but you can see we're up about, this is the 12 months to March, so it includes the last quarter. We're up almost 18% in a small industrial market that's flat. So we've outperformed by that 18%, which we're pretty proud of. You can see there that on the bottom left, small industrials flat, small resources up 52%. Now that's just unbelievable. That's the world we live in. Gold stocks and iron ore and coal are absolutely on fire over the last 3 months, particularly, but you know, the last 6 months, and it's due to restrictions in supply chains and the tragic scenario in Russia and the Ukraine. And obviously, when resources stocks fly that hard, then we are not participating in that proportion of the market. But that doesn't worry us because it's not a market part of the market that we want to. You can see the fund size on the bottom right hand side. We're at about 850 million. Now that to us is more or less optimal, and there's never a perfect answer on what the size of the fund should be. We just know we don't want it ever to get too big, and that's why those who have been around with us for a while will remember in 2016, 17, and 18 we gave back about 30 or 40% of the funds under management slowly because we'd outperformed, and we just don't want to get to that position where we wake up one day and realise that we're too big. Now there's stocks there, the best and worst performers over the rolling 12 months. The good news is that the 5 stocks that contributed the most, Johns Lyng, UNITI and the like in that second left column, They were all our biggest weights in the portfolio, so they are meaningful contributors. So if you look at something on the bottom performance, if you look at EML payments that fell a lot, keep in mind that the difference there is that EML payments was 0.5% of our portfolio. UNITI Wireless was 6% of our portfolio. So we're in the business of taking risk, and we're also in the business of making mistakes or having certain risks go against us. We just need to make sure that the biggest positions we take and the most conviction we take are in those stocks where we have the most upside. And thankfully, in the last 12 months, that's really come home. The chart here shows a long-term track record. So this is every calendar year since we formed. So the 17 years there, it's outperformance after fees compared to the small industrials. So anything above 0 means we've outperformed. And you can see there's only 3 years where we've underperformed out of 17. And equally, actually, I think that chart's a little bit out of date. Sorry, that we might have to come back to that. But so see how it says financial year to date? That's supposed to say calendar year, and we're up 21% compared to the small industrials, which as I meant, that was last year, and that was one of our better years. We had a couple of flatter years. You can see in 2019, 2020, or 19 was underperformance. Now, a lot of that was due to this. Where am I? This chart here shows you that the tech stocks, so this is growth versus value stocks in the US. And you can see that the tech stocks, look at the tech boom back in 2000. That was where if you weren't in growth, you were a loser. But that dried up very, very quickly. And you can see on the right-hand side in 2019, 20, you had a mini version of that. It was a tech boom. There was literally, there were tech stocks that we thought we were smart owning and then tripling our money and selling out, things like WiseTech and Afterpay. We sold out of WiseTech, for example, at $15, thinking we're very clever. It went to $45. And that was an environment where there was no regard paid whatsoever to valuation. Now, we're very strict on valuation. So if we go back to the relative performance of the fund, when the tech stocks absolutely, and they've been the worst performers. You can see this correction, but in Australia, they've been very, very savagely dealt with because we don't own those stocks at the wrong price. We've been insulated largely. If I go back to the performance page here, where are we? So we mentioned the 1 year numbers. If you look at the last 3 months, now we would never invest on the basis of our view over 3 months. It's just not how we're wired at all. We like to build models and understand cash flows over 5 to 10 years. But it's kind of always worth looking when the market changes direction quickly. How did that affect us and what does it do? And you can see in the last 3 months, the small industrials is off 9.1%. We're off 9.5%. Now, I'd rather have outperformed that because we are relatively conservative. But two things happen in I call them trapdoor markets, where things just fall out very, very quickly. And they can hurt us, and they have a little bit. And it's micro caps tend to get, so anything below a market cap of 200 million tends to get hit more savagely because illiquidity in panicked markets, and equally stocks that make their money out of the markets, and that's things like Charter Hall and Pinnacle fund managers. When there's a big downdraft, they will always underperform. Well, we do have a reasonable weighting to those stocks, and that's a short-term thing. But you can see there that if we're sort of I think also it's fair to say that if you had outperformed very, very strongly, also compared to the broader market over the last 3 months, then you would have had a very heavy weight to resources, which again, a reminder that's not a part of the market we're in. So this is just a new way of representing something that we've banged on for years. This is the US market. I'll just for simplicity's sake, I'll pick out the right-hand side first. The smaller the market cap, the fewer the analysts that look at the stock. So that's exactly why we love these stocks. And if you think the number of stocks increases, the further to the right you go, it's just that equally the number of eyeballs on each stock almost fades away to nothing. And you can see on the left-hand side, 98% of small caps in the US don't have analyst coverage at all. Now, there's plenty of stocks that we own and have owned for years and have had very strong returns on that have no analyst coverage at all. And we're actually happy with that because we can find things that not many other people are looking at. If we talk about the market conditions, so here is here are kind of a collection of thoughts that I'll share with you because they're on everyone's mind. They don't drive how we invest in an overall sense. So we're not asset allocators, and we don't make calls on what we think the equity market will do, and therefore should we be in cash or stocks. That's a call that's made by experts in that field. We're stock pickers. We're disciplined to only invest in whatever the market dishes up, and it's very hard to predict. We will invest accordingly in the best stocks of that environment. Inflation is the key word. It's a huge risk, and it was brushed aside by markets midway through last year as a non-event. And we kept being told by the Fed and various experts that it was transitory. There were very, very big warning signs that it wasn't. The most obvious one to me, and it's anecdotal, but it touches every breakfast table in America, and that was when General Mills came out in November 2021 and said they plan to raise their prices on cereal by 20% in January, and they have. And so, if you think about how that affects, because there's a certain esoteric element to some of this inflation, that is that the nickel price is running, or fertilizer prices are running, and none of us buy nickel or fertilizer, but we do buy breakfast cereal. And when General Mills passes that through, that's hurting Americans and Australians. It'll come through here, but that was just a really big sort of turning point, I think, where people realize, oh, hang on, this is actually going to affect people individually, and it's not going away overnight. And remember, that was before Russia invaded the Ukraine, when there's an obvious tragic element to that, and it's horrible. But the Russia-Ukraine situation is another pressure point on inflation. The system was already stretched. And the two problems are, and it's very hard to see how these go away, and that's the disruption to the supply chains, but also something that is yet to fully play out. And that is that I think we realised during COVID that the economies, particularly in Australia, but even in the US, the economies they had some blips, but they actually didn't crater quite as badly as people thought. But in the meantime, during the fear of a serious cratering in the economies, the Australian government and the US government and governments all around the world came up with massive fiscal stimulus packages. And the May budget last year was spend. Americans are spending trillions. Now, that takes a while to come through. And so if you realise a year later, hang on, the economy is not actually that bad, but there's a wall of spending coming, that just takes a balloon that's pretty strongly inflated and blows more air into it. And I can't see how that instantly translates into lower inflation. So the question from here is how far it goes, how much the market is implied in the correction to date and the bond markets, and equally, will the Fed just simply raise rates, or will they see some merit, as they have done in the past, of protecting markets as well? And I don't have the answer to that, by the way. But anyway, so that adds up to a pretty fraught overall picture. But I've done this for long enough, and I think most people on this call have been around long enough to know that every time at about this time of year or January, everyone does their kind of, summation of what the market looks like. And there's always 10 things that you cannot answer. They're massive risks. You'll never see a slide like this say it's perfectly benign, we're comfortable, nothing wrong can happen. It's just not the world we live in. So whether or not this actually becomes as bad as we fear, then, time will tell. It's much more interesting to us, and we'll come back to this in a second, how do we invest in that environment, given that the uncertainty is high? Before we get to that, I'll just give you a bit of feedback. So just remember, as a reminder, we don't invest according to our view on inflation. We don't invest on a view of the Ukraine situation. We don't have those views. We're not prepared to take risks, and that we're smarter than everyone on those sorts of issues. And so, excuse me. If we look now at the things we are very, very interested, this is where we do all of our work, and that's what's happening to individual companies' cash flows that will affect our ability to understand their valuations and identify risks that are specific to companies. Because inflation might be a big risk, but it's not a risk to every company by any stretch at all. In fact, inflation can be very good for certain businesses. So we need to drill down and ask the question of every stock that we look at. So just a few quick comments here. There's plenty of business models that don't have any risk of inflation. They don't have any risk of consumer sentiment or behaviour or cyclicality. And we've mentioned a few there. I'll drill into some detail in a second, but things like Aussie Broadband, AUB Group, EBOS, Hansen selling software to the telecommunications industry, that it's billing software, they get paid every day. Johns Lyng Group, which does repairs for insurance. Those sorts of companies really don't have any cyclicality, and that's coming through. The market was particularly unkind to anything in February that missed its number or presented anything that was less than a 10 out of 10. And we saw two of those that hurt us, and that was CCX, which we've mentioned there, with a little bit of an elevated inventory. Now, retail, so CCX is City Chic. They sell plus size apparel globally. They built up their inventory because they couldn't get it because supply chains are so busted. Now, any retailer who shows an elevated level of inventory, the equity markets are tuned to say, oh, wow, you can't get rid of your stock. You're going to have to discount. That's a bad thing. It's just that they cleverly built up their inventory, but the stock price fell. It's kind of shoot first, ask questions later. And same with UWL, I mentioned there. It's a growth story that's got 10 to 20 years of growth. And there was one tiny thing they missed, and that was a construction of a few new projects. And the stock price fell by 30%. Now, we bought as much as we possibly could, but it's just in a volatile market, you had a few things like that playing through. There's other areas. You've got to break up the economy. I think there's a temptation to think small companies are one thing. They're not. They are hundreds of different things that are unrelated, largely. Those that rely heavily on the house price strength in the last 2 years, I think, will struggle to maintain that level of buoyancy, and that's because immigration has dried up for the last 2 years. So there's not that huge sort of demand support for housing, and equally interest rates are going up. And over the last 2 years, people have been sitting at home completely bored, couldn't travel, couldn't go to the pub. They've been buying stuff, couches, TVs, whatever it is. And they've been doing so with the confidence that not only are they being handed out money, but equally that their houses are rising in value. So retail, in summary, retail is something we'd be very cautious on. Tourism will recover, I think. Touch wood, you can't predict anything these days with great certainty, but it can't get much worse. But equally, most of the tourist stocks we look at, the valuations are already implying a big recovery. And I wonder whether or not we're going to go back to 100% of what we used to do. I think it'll probably go back to 80%. There's a lot of travel that we just won't do again. And I mean corporate travel largely. We mentioned the labour market's being tight. The financial platforms are performing well, taking market share. And at that last point, there's been a little bit of sort of call it disruption in the funeral industry, in the healthcare industry. You know, radiologists have struggled a bit because of the ban on elective surgery, but that's all very, very short term. And to us, any volatility in share prices has been fun to take advantage of. So we've got some stocks here. Thank you. So some recent purchases and excuse me, and sales. I won't go through every stock here. Why don't I just pluck out two recent purchases? One, Healthier, is a very small holding of ours. It's a company that is backed by the people that were behind a company called Green Cross, which was a very, very successful roll-up of the veterinary services market. They bought private vets, rolled it up into the largest operation, and you're able to, because it was so fragmented, most vets were private, then a corporate player can actually roll up the market pretty smartly and grow very, very strongly. These guys are doing that in physiotherapy and optical care, and very fragmented market. Most physios are still single operators, or they have a few in a crew. They might have 3 clinics. They're pretty small. So Healthier same with optical. So Healthier recognises that over, let's say 5-10 year period, by buying them at reasonable prices and rolling them in, you can take their market. And so Healthier would be the biggest player, but it's only got 2% market share. You can get that from 2 to 4 to 6 to 8, hopefully, if it plays out. And that's heaps of room for growth. Now, as I said, it's a small position now. It's not without risk. It's definitely profitable. We hope over a longer period of time. We hope to own that for a long period of time if they perform well, and to be putting more into it if they grow and become more robust as they get bigger. Freightways, when we put in brackets there that it's new, it's a stock that we owned for 10 years until about 2 years ago because the valuation got up there. It's a business we know well. They're the second largest provider of parcel deliveries in New Zealand. And they compete with New Zealand Post, who is an ideal competitor. They've got most of the market share. They're bloated, they're inefficient, they're unprofitable, and frankly, they are late with their deliveries more often than not. So Freightways, being a very nimble, well-run operator, and they charge a premium, so it's more expensive to use them, but at least your product gets there on time. And it used to be you'd cop a delay. People just don't cop delays anymore the way they used to, so they'll pay a higher price. And you can see we're topped up on plenty of other stocks there, Hansen, Propel and Aussie Broadband. In the sales, because we actually have, so the last 2 years, we've had some reasonably large position changes in our portfolio. Just going back a step, I mentioned at the start that stocks like Main Freight, Lifestyle Communities, Johns Lyng and UNITI have done phenomenally well over the last 2 years. They've been our 4 biggest weights. And they're up there at 6% of the portfolio. 3 of those we've sold most of our stock, and it's just because the share prices, we love the business, but it's just the share prices have run ahead of what we think the value is. And so Main Freight, Lifestyle Communities and Johns Lyng are now much lower weights in our portfolio, so we've had to deploy that. We haven't had problems doing that, but hence the left hand side there with the new purchases and buying other things that we own. Other things we've sold, we mentioned Lifestyle, but we sold out of Premium, Lavisa and Collins Food. They just, they did well, hit the target, and we're out. And Napier Port and Macmillan Shakespeare just didn't really grow the way we expected. They didn't cost us, but we thought we could do better. Here's a sort of a chart that I did this a year ago. In fact, I do it every year at March, and I update this chart, and it really doesn't change much at all because I use the same format. It's the representation of the categories of sorts of stocks we own. So when you can see there, the 2/3 of our portfolio is in what we call defensive stocks. Now, it's not really defensive in that it's just defensive. They're actually growing. It's just, I guess another way of putting it is non-cyclical. So businesses that can operate in any economic environment that don't rely on things like consumers being happy or buoyant or house prices rising or whatever it is, or building activity. And it's, all those stocks that I mentioned before, things like AUB Group, Lifestyle Communities, UNITI Wireless, Aussie Broadband, Propel Funerals, these businesses. So telcos are a great one because everyone pays their telecommunications bill. Insurance is another one. We don't like insurers because they take all the risk. We love people who broker insurance. So insurance brokers is a great business. Anyway, so that's that's where since the start of the fund, they're the stocks that Steve and I love, and we own them for a long, long period of time. But we're not completely averse to looking at other things like cyclical stocks, and you might have 1 or 2 marginal. So City Chic we would put in there. It's a cyclical and that it's a retailer, but we think it grows strongly anyway. Then when we talk about, but we've got to understand that the cycle has the propensity to grow, or the potential to grow, and to move the share price. And you can see there that the weight is very small, so it's not a huge part of our portfolio. Beta stocks are another category there. We pull them out separately just because they do move in exaggerated moves compared to the overall market, because they're tied to the market, and it's things like Charter Hall and Pinnacle and Moelis. Now we're happy to own those sorts of things because when they grow really, really well. Equally because they're so leverageable, but we just want to keep that overall weight we don't want it to be 50%, because then if you get a downdraft in the markets, then we're going to be all over the shop. And then you can see cash at 3%. That's where it should be at all times. And when we call what we call high growth stocks, that's a collection of about 10 to 12 companies. So read into that there are no big positions in here for us. There's no large exposure. It's a spread across a larger number of stocks that all have a very, very strong growth rate. It's things like ProMedicus, which is growing at sort of 50 to 60% in the US, enormous markets. And that's a good example of these stocks. The good thing is that they can grow very quickly. The negative, and when I say negative, the reason we only hold tiny positions is that because they grow so strongly, it is and their industries change quickly. It is very hard to pinpoint what they're worth. So when we can pinpoint what something's worth, like UNITI Wireless, and we really know it's growing and the error rate is low, then we'll buy a lot of it. If we can't, but we still think it's potentially going to give us strong performance, then we'll buy a small position. And that 8%, that's a key reason why we didn't underperform when the tech stocks pulled back, because a few of them fit into that category. So I'll talk now about a few of the major holdings we've got. Excuse me. UNITI Wireless, or UNITI Group, sorry, as they're called now. We've owned it, you can see, since the green dot. These guys have, and we've known the management team. They were also the management team of M2 Communications, which was our biggest holding for about 10 years before it got sold out into Vocus. It's a very well-run business, and it's a direct competitor to the NBN in the only area that the NBN has any competition. So NBN's a monopoly, except when there's a new development of a suburb out in the outer reaches, and a property developer. It's the only time anyone has a choice. A property developer can choose the NBN or anyone else. Now, there's not many in the anyone else category, and in fact, UNITI Wireless is the only one of any scale. They get 30% of that market. And once they've connected up the suburbs, which the developer pays for, they then connect to each household as people move into these new houses. And it's $52 a month for as long as they're using broadband. So it's a sensational infrastructure asset. You can see there the retracement in the share price after the result. That's what I mentioned earlier, when the market lost its nerve, and we had been selling all the way up because it's done well, but the market completely misinterpreted the result in February. And as I said, that was when you had a whole lot of other tragic things going on in markets, moving into timeframes of weeks rather than years, and we want years. So we're happy when people fold and become irrational. And so we went limit long, meaning we bought as much possible as we possibly could when it fell back. And very soon after, fortuitously, and we don't invest on this basis, but the value was recognised pretty quickly because you've had two takeover offers at $5 lobbed, and it's by people like Macquarie and infrastructure funds who know the value of this business. We think it's worth more like $8 over a long period of time. So do they. That's why they want to own it. We're disappointed that if it does get sold out at $5, we'll be disappointed because we think it's worth more. But ultimately, we're just price takers in that environment. Aussie Broadband is another telco that we like. We've got it's not a huge position. It's kind of a mid-sized position for us because it's growing so strongly. Again, it just goes back to that. The higher the growth, the higher the error rate, which means the higher the risk. We just need to be accounting for that with the amount of stock we own. These guys are the most recent credible challenger brand in home broadband. So everyone who's on this call now at home uses broadband through, whether it be Big Pond or Optus or iiNet or Dodo or TPG. These guys have come from nowhere with a brand, Aussie Broadband. You've probably seen the TV ads. Their proposition is simple, and that is that most of the large operators, it's a mature industry, most of the large operators have cut costs, and to their own detriment, the biggest cost they've cut is outsourcing the service department to overseas call centres. And I think most people on this call have probably had a frustrating experience trying to get you have to have your broadband working, particularly if you're working from home. There is no choice, and you're often on hold, or you're talking to distant lands, and you're getting a completely unsatisfactory result. Aussie Broadband has only Australian-based service staff. They fix things very quickly, and I haven't experienced it directly. Steve has. He put them on. He couldn't believe how good it was at home. That's a sample of one. The real sample is looking at their growth rate. So in the last 2 years, they've taken their subs and tripled them almost. And the business subs have grown by almost fivefold. So whatever it is they're doing with that service offering and the marketing, it's definitely resonating. Now, their market share is 6%. The question we've got is, can that go to 10 or 12 or 15 or 20? We will find out. We know at the current share price that if it goes to 10%, it's still worth a lot more. And very well-run business. Management owns 15% of the company. And again, we don't have to, it's not a cyclical business. EBOS is a rather, I say this not as an insult, it's a rather boring company, but it's boring in a good way. So that they're one of the top 3 distributors of pharmaceutical products to the chemist and pharmacy industry. So when you walk in, everything on the shelf comes from one of those 3 players. It's their warehouse operation. It's been growing at 10% for years and years and years. Their 2 biggest competitors are API and Sigma, who are just not as well run by any stretch. Change in management, slippage in market share, change in IT systems that have had problems. This is a very well run business, and people are still. It doesn't matter how bad. If the whole world stops buying couches and TVs, you'll still be going to the chemist pretty regularly. So it's a pretty stable operation. Propel Funerals sort of explains itself, the industry, and frankly, for obvious reasons, it's one of the best industries you can invest in, because if you look at 10, 15, 20 years even on this, you know that there's nothing you have to do to think too hard about what the demand for the product's going to do. It's just going to keep growing very mildly with the aging population. But it ticks away. There's nothing cyclical about this whatsoever. bizarrely, so we bought stock, you can see there, in December 2018. That's when we established a small position. These guys are buying private players and growing that way. Bizarrely, you can see what happened in March 2020. Then this is when we bought most of our stock when it came back to $2.20. The stock, because there was a ban on attendances at funerals, the share price of this company fell by 40% in 3 weeks. And now that is just completely bizarre. Even though at that point in time, no one knew anything, we knew people would be back at funerals. And we also knew that no one would stop dying. So we bought a lot more, knowing that the market had just gone into that a time zone of weeks, a time frame of weeks rather than years. We live in years, and we're happy, we're wrapped when people lose their nerve and go into weeks. It's great. So it's kind of reverted back. You can see it's re-rated back towards its you know, where it's in a more appropriate valuation. But from there, they've made acquisitions. There's a sense that they can still grow, and we think they will over a long period of time. And the people that found the business are large shareholders, and so we know that everything they do is in their and our interests, not just they're not just taking a salary. MA Financial used to be known as Moelis until about a year ago. We had a small position. It's a sort of I guess a mini version of Macquarie. That's probably a reasonable way of describing it. It's a fund manager with advisory services and broking services attached, but it's mainly a fund manager. And they operate slightly outside. They don't sit in the middle. They don't do just boring Aussie equities or large, you know, property funds and the like. They do relatively innovative, and I think obscure is probably it's not the right way to put it, but they do innovative products for income. A lot of it is for income, and their client base until about a year ago was largely high net worth individuals and Chinese visa investor market, the CIV market, if that means anything to anyone, where in order to get a visa, you have to show that you've got $5 million invested in Australia. They've captured a lot of that market. You can see their FUM on that third last bullet point has gone from 800 million to 5.4 billion. Now that shows you how strongly they're growing. Now take a look what happened in March 2020. The share price fell by 65% in 3 weeks. And that's because at that point in time, financials, I mean, you couldn't have an asset class in the world that was more on the nose, and these things change quickly. But when it fell, we got on the phone to them, make sure the balance sheet was okay, and we had to reassess at a much lower price. We realised at that lower price, it was trading below cash backing, below their investments. And we knew their investments were safe because the balance sheet was okay. So we bought a lot more then, and that was the right thing to do, because again the market had gone into sort of a blinkers on panic mode, and since then it's recovered nicely. They are still growing. The thing we like about, and then they've moved into the independent financial advice market. So rather than just sort of wealthy mates, their client base now will become increasingly planners, more bankable clients, much more broad and diversified, and they've got a lot more product to sell. The other thing we really like about this, so if you think about they've got 5.5 billion now, they can get this and want to get this to 10 or 20 or 30 billion. And a lot of these businesses, so that sort of sounds flippant, but Charter Hall was running 8 billion when we invested in it, and it's now running 70 billion. So there is a lot of headroom for FUM that they can garner, and management still owns a third of the company. So there's 6 people that drive the business. They see this as their private business, and I don't mean that in a bad way. I mean they're hungry, and all of their success, if it works, we'll enjoy as well. And the last one is it used to be called Ausbrokers, AUB Group, which is an insurance broker. It's the larger of the 3 listed insurance brokers, and we own all 3 of them because we like the industry. It's got very low churn rates, and it's very predictable. The one bill that anyone in business will always pay, or the 2 bills actually, you pay your phone bill and your insurance. There's just no way you're going to be in business without paying it. So it's not like Tim Tams in the tea room. It's not discretionary spending. So very bankable. They grow at about 10%, but you can see the share price has kind of run pretty hard in the last couple of years. It's because the growth rates have ticked up with some efficiency, and new management came in, and they've really driven this business very well. And we can see over a long period of time, not much volatility of earnings, and because the market still has fragmentation, they can buy private players and keep growing. So I'll leave it there. I'll just leave the last page I'll put on is our top 10 holdings. With the valuation. So John's Ling, I would point out that we've sold a lot of stock. So this chart here is about a month old. the stock price has done very, very well. You can see the valuation is elevated, and as I mentioned earlier, we have sold a lot of it. So I'll hand over to any questions, and thank you.
Thanks, Ed. That was very comprehensive. We have had a bunch of questions that have already come through, and you can obviously still ask further questions by entering them in the Q&A box. Just in response to the first question, yes, the presentation will be available post-call. The second question is the market conditions slide paints a pretty negative picture, and this person understands that you are stock pickers, but what's the upside scenario for the market as a whole?
Well, that's a good question. It's just not. It's not something. So we have never and would never predict overall market returns. And I think so. I guess what the reason I put all the charts, that chat about inflation and Russia and all those sorts of things is not to tell you, and therefore we think the market is going to fall. We've got no idea. It's not what we focus on, nor is it how we build the portfolio. And I guess I would remind you that. So we've done that every year, and I was looking back at prior years. We prefer to be sober and tell and identify the key risks that we can't control, and just remind people that we invest as best we possibly can, given the obvious risks at any point in time. But just as a reminder, we've had that chart. It's just been different risks every year for 17 years. So at the start, every March when I do this, I put in the bullet points of the uncertainty, and the unfortunate fact about markets is, so we could have been uncertain after the GFC, could have been uncertain during COVID. The fact is that uncertainty, the riddle always gets answered, and it doesn't always mean that the market falls, because, in April 2020 with COVID, so quite literally no visibility around the world, you could have put those bullet points up and built an argument to say that therefore the equity market would fall, and it rose to a record high. So I just I'm not ever going to tell you to build an expectation from anyone that we think that we are building a forecast of markets being down. Asset allocators will have stronger views on that, and they're much better positioned. But we live in the world where people have decided to invest in equities, and that's all we do, irrespective of what the macro risks are. We just make sure we're not exposed or telling you that we've outsmarted the market on inflation or the Ukraine or whatever it is, or COVID, because it's just not how we invest.
I think that's very clear. Next question. Recognizing that the fund avoids resources, have you looked closely at any part of the electric vehicle supply chain or any associated technology in that space, or do you still regard that as too speculative?
We'd love to, yeah. I mean, renewable energy in general, absolutely. The problem is there's actually, so it's such a good theme. You know where it's going. You know you want it to succeed. The problem is we have to drill down and say, okay, what stocks do we buy and how risky are they? So unfortunately, most of the technology providers are in unproven technology. So it's all very well to have the growth opportunity there, but unless we can value the stock, or they've got a product that's actually been sold, has been used, has been proven to work, then we would never invest in it, because we're just speculating on outcomes. The only stock that we own that I think could loosely be described as falling under that category, and it's big. The other thing is, so renewable energy companies there's almost none of them left listed, because they've all been taken over. So Infigen was the last one, the big wind power business. But there is a stock called GenX, which we own. It's solar, wind, and battery power. They're building projects. It's very, very well structured in that these projects, as they come on stream over the next 2 or 3 years, will be profitable. It's underwritten by government take or pay contracts for the electricity. They've got huge bankable, very, very tightly banked debt structures, and lots of opportunity to grow. And we get in there and make sure we understand the cash flow valuations on these projects as they come up and running. And they don't rely on the success or failure of any technology whatsoever. They only use technology that's proven. We think it's worth a hell of a lot more. So we've got a smaller position, but it's quite literally, it's the only listed renewable energy company that we can find. So yeah, we'd love more if it was within our risk parameters.
Makes sense. The next question, I think you largely did answer. It may have been asked a little bit early on in the section of the presentation, but I'm going to ask it anyway and see if you want to add anything. It is, can you share your thoughts on UWL and how it plays out in terms of additional buyers bidding, potential prices it gets taken out at, and post UWL being taken out, are you solely exposed to ABB in the smaller telco space? Do you have a view on TUA?
Yes. So first, with UNITI, so there's three scenarios because there's two bids and they're conditional, but there's three scenarios that can happen from here, and I'll tell you how we'll behave accordingly. One is that so there's two groups of bid $5. We could get, the scenario one is that one of them pays $5 and owns it, and that's that. Scenario two is that someone comes and pays $5.50 or $6 or whatever it is, and that could happen. We'll wait and see, but that's speculation. We don't know that. We would not invest thinking that we know that that's going to happen. I think it would, and I hope it does, obviously, because we've got a big investment in it. But it's not how we invest. So I'll come back to that in a second. Scenario three is that both bids are pulled and the share price falls. Now, that has happened in a lot of these deals. So telling you that I know which of those three is going to happen is only speculation, and we never speculate. This is how we run it. So we've got 7% of the fund in it, which is the largest position we're allowed to have. The two bids came out. We've sold 1% because it's moved towards where, it's getting closer to being that the likelihood of just one of them paying $5, because remember, it's trading at $4.80 now. So for us to have an investment of 6% of the fund in something, we have to be sure it's worth a hell of a lot more over time, not just 20 cents more. So between now and the outcome, which is someone buys it, someone pays more, or they both pull out, we will have sold down gradually, because we don't want to get to that last bit where we're exposed to having 6% of the fund in a stock where all the bids are pulled. Now, if they are pulled at that point in time, we will own less and we'll buy a lot more if the share price falls accordingly. So it's when we're in a realm where Steve and I really have not had many takeover offers at all, particularly in a large position. So we're in a bit of a realm that's new to us, but that's the simplest way to remove all speculation. It's just, if you can't answer it, don't. Because I think a lot of people will fall for, oh, wow, this is getting exciting. Someone's going to definitely pay more, and we'll make sure we're at 7%. And then if the bid gets pulled, unfortunately, your unit price is going to get carted. So we just need to be careful of that. Now, as to the second bit, Aussie Broadband, from memory, is the only other telco we own. We like the sector. There used to be a lot more telco stocks, and we used to own a lot more of them. There's just not that many of them left listed. Now, TUA, I'd have to be reminded, is that just I'm not sure if I can access it here, because the stock price the stock code has changed. I'm not sure if that's if that is TPG or not, because the stock code has changed. So I'm caught on the fly there with the code only. So if the questioner has the full company name and can confirm that it's TPG, I definitely have a view.
The reason I referred to it as TUA was I also didn't recognize the code. Let me just pull it up there. What I'll do is I'll pull it up there while I'm asking the next question, which is, what are the distribution expectations? The fund is obviously now at around the capacity you like to manage. What are the expectations on distribution?
Well, so the distribution, so there's two elements to it. There's the bit that we can't control, and that's the extent to which we have to distribute all dividends and all realised capital gains. And then there's a distribution which we haven't done for 2 or 3 years, which we did do for 3 years in a row in 16 to 18. And that is the distribution that we do when we think the fund is just getting towards too big. So we hand back a bit of capital return just to trim the size of the fund. So on the first one, we'll find out over the next, so between now and early June, we get a better picture of the extent to which there was capital gains realised, and they will be paid out. And it's just a bit early to comment on that. And then if, let's say we're heading into June and the fund is at about 850 million, I would say to you, we won't be doing extra capital returns because the fund size is about right. But I do just sort of, I guess, remind people that if we get to if over the next, call it a 2-year period, if the fund size, because let's say we have another big year of performance and the fund size, we add, let's say 15%, then that's going to get us towards $1 billion. Then we would want to hand, 10 to 15% of that back. Now that can come through the capital gains that we realise, and that will just be an outcome, or a discretionary sort of increased payment. So I've just had confirmation from Kaz. TUA is TPG, which I thought was, sorry, just a bit of confusing because they changed the code. So TPG is a massive telco that years ago was great and to own. We did own it because it was a small telco that was growing vertically, very, very clever, very well run business. And they put on a lot of their own networks. They replaced a lot of the economics that they were leaking to other players, wholesale players, and they really cleverly rolled out networks. And so it grew like the clappers. Telcos like that are great, but they invariably hit a wall of growth. Optus was the same years and years and years ago. Not that it was a small cap, but you can grow as a shoot and you can really fly because Telstra's got so much share to take. They're so big they don't even know they're losing half of their share. That's what Aussie Broadband looks like. It's what UNITI looked like a year ago. It's what M2 looked like years ago. It's like what TPG looked like years ago. But TPG now is just too big. It's very, very hard to grow from the level they're at. They're moving into mobile and spending billions of CapEx. The returns on mobile are nowhere near as good as the returns on incremental CapEx in broadband. So we wish it was the old TPG, but now we've looked at it. To us, it's just not growing enough.
Thank you. Next question. What do you see as the growth drivers for equity trustees?
Equity trustee, it's not going to grow a lot. It's going to grow mildly. The main growth driver for them, there's 2 or 3, but the main one is that they're a trustee for superannuation funds. A lot of corporate and union funds still do internal trustees, and since the Hayne inquiry, there's the banks and anyone in the financial services industry is at pains to remove any sense of conflict of interest. And an internal superannuation trustee can be seen as a conflict of interest. And rightly or wrongly, they just need to clean up and look like they've done all their probity work. So there's a lot of outsourcing to people like us, equity trustees. They're the biggest player in the market. There's only 2 or 3 players of consequence. So they have actually 1, 2 or 3 larger books of business, and there's still plenty that they bid on. So it's a great way for that large corporate sector to solve the perception of a conflict of interest. And then, so that's one, they're established overseas in Ireland, and that's not yet profitable, but it is growing, and over a long, long period of time, that could become a nice growth option. And then really, Equity Trustees is a pretty old business. It's got a lot of old clients, and to grow, so they also make a lot of money out of wills, signing up wills. So they have actually increased the sales focus, and it was fairly sleepy. We've looked at this for years. It's over 100, I think it's over 150 years old as a business, and sometimes you wonder. A lot of that comes through in that they're slow growth. New management came in about 4 years ago, so they are growing that business. But the thing is, if you grow your will book, it takes a long time to start earning money on it because you've got to wait for these people whose wills have come onto your book to die, frankly. So it's pretty slow and steady. So with equity trustees, I wouldn't want to build an expectation that it's going to all of a sudden rocket up like a MA Financial, which if they grow their FUM, that can literally be worth 3 times the share price. Equity trustees is very, very conservative, very stable, and probably grows in that 5 to 10% range.
Okay, we've got a lot of questions still coming, so I'm going to try and get through them quite quickly. If you can keep your answers sort of reasonably brief, that would be great. Sure. Pinnacle, has that been oversold, and what does the future look like? Do you have that in your portfolio?
Well, we still have a small position. So, yes, we think not so much oversold. We just think it's worth more over a long period of time. They're good deal doers, very, very well-run business, very diversified. You can't wake up one morning and find that you get a Magellan within Pinnacle, or you might get one, but they own stakes in over 20 fund managers. So it's not exposed singularly to one investor, the way the Magellan problem emerged. Long term, the management still owns a large amount of stock. They do want to do deals. They've done good deals in the past. And so we think over a long, long period of time, absolutely, we want to own. And it's, as I said, it's not a huge position, but yes, we think it's got value.
Right. Did you participate in the recent PSC insurance raise, and how big do you think that business could get in 5 years' time?
So we already had a reasonable position. We didn't need to buy more. It's just because we own a lot of it. It's not to say we didn't like the raise or the reason they're raising it. We just didn't need more stock. Long term, it's definitely got a lot of growth. The same reason as Austbrokers, in that there's still a fragmented rump of the Aussie industry that is available for acquisition. PSE grows organically faster than Steadfast and Austbrokers. I think that it's a really well-run business, and that's come through in the numbers. And equally, they operate in the UK market, and they've successfully bought higher growth in businesses. We think that's more risky, so that's why we own less of it. But it is actually a bigger market. It's far more fragmented than the Aussie market. It looks like the Aussie market 10 years ago. So there's definitely growth there, and it's a very well run business. The key executives still own. I'd have to double check this, but it's probably 30 or 40% of the company. They're very attached, very driven people.
And sticking with the insurance industry, where do you think we are in terms of the premium rate cycle?
Late stage in a strong cycle. Not to say I've got any insights that it's going to fall, but the insurance premium cycle in most sectors has been strong now for about 5 years. And it's because the insurers haven't been cutting each other's throats on price so much, because their investment returns, particularly in fixed interest, are so low that they've sort of just quietly earned more money out of just doing what they do. But you get scenarios where they do hack into each other on price, and that could happen. Now that's not the end of the brokers, because they still, if commission is leveraged on rate and rate falls, then they can put fees in, and it's been proven in the past. It's just a bit harder to grow. But I'd say, we're late-ish.
Perfect, great. Next question about Hansen Technologies. Do you think Andrew Hansen would still be a seller at a price? And would he prefer to remove the company from being publicly listed? And secondly, do you still see good value in the current share price? The business seems to be performing well, and the acquisition pipeline seems to be getting stronger.
Yep. So the second one first, absolutely. You can see that it trades on 16 times. It's a business that is involved in non-discretionary software with long-dated recurring income in a global market, and they've grown, at 15% for a number of years. So that screens very well on valuation. So yes, we hope it doesn't get taken over. We didn't block the takeover, but we didn't like that takeover at all. It was just, as I said before, with UNITI, often the people who want to take your company over do it for the exact same reason we own it, and that's because we think it's worth a lot more over time. Now, coming back to whether or not Andrew Hansen is a seller, Andrew Hansen wasn't a seller in the proposed takeover. He was going to retain his position. So that was what we, and I'm happy to disclose this in public, we had a problem with that, in that we agreed with Andrew Hansen, and that is we wouldn't sell. We didn't want to. We thought that was the wrong price, and so did he, because he didn't sell. If he thought it was overpriced, he would have sold. So and when I don't know if someone's going to take it over. Time will tell. That's speculation, but we certainly want to own the stock. We've got a large position in it. We think it's a great business.
Second last question that we are going to get to is, if the fund only invested in its top 10 positions through its history, do you think that the returns would have been even better, or do you find that having the broader exposure to smaller positions add to the total returns? Have they graduated to the top 10, and would you miss them if they weren't there, basically, I guess is the question.
Yeah, I've never looked at it that way, but absolutely, without having smaller positions and the ability to look at them and watch them grow, they wouldn't get in the top 10 anyway. And I'll give you a classic example. So M2 Communications, which mathematically is the single best stock we've ever owned, i.e. provided the highest level of positive performance in our fund. Originally, when we bought it, it was capped at about $30 or $40 million, and we put a 0.5% position in it. That was at 25 cents. It ended up being taken over at $12. Now, we wouldn't. So if we only ran 10 stocks, we wouldn't have invested in it until about $10. So what happened over that period of time, start off at low weight and then get more comfortable, and then the share price runs, they prove their growth. So we buy more at 40, 50 cents. And then it becomes a 2% position at 3%, and it ultimately ends up at 6 or 7%. And but only through a long period of getting comfortable that they're doing what they're doing well, and they're doing what they said they would do, and it's coming to fruition. So if I look now, if I think about, okay, what's the next, who else could do that? Then that's why we invest in a whole lot of smaller stocks, because we think, well, over a long period of time, that could do, and we could charge. So Healthier, for example, if the plan works and they keep buying physios and optical, the share price will be higher. We'll be buying more stock. They'll be doing capital raisings. They'll be buying more businesses, and our weight will be bigger. And who knows, in a period of time, they could be capped at $1 billion and be sitting in our top 10 and still be worth a hell of a lot more. Do you see what I mean? So we take such a gradual approach. So there's nothing in our top 10 that you're looking at now that hasn't been built up over a long period of time. So they all start at small weights.
I have confirmation here that TUA is in fact independent from TPG. It is David Teo's Singapore business. I'm assuming that's not a business that you're familiar with.
So hence the confusion. Sorry, when we talk stock code, sometimes it's literally not a stock we look at. It's based in Singapore, and my memory is liquidity is low. It's because it's domiciled in Singapore. We're not. It's weird that it's listed in Australia. Put it that way.
And now the last question is: have you and Steve added to your positions in the fund in any way?
Yes, I have. So in January this year, I invested. So we invested, I won't talk for Steve because he's not here. We invested superannuation and personal money in 2004. I actually borrowed to put it in. Have topped up all the way through more recently, pretty meaningfully in January this year. And I've never taken any money out. And it's still a large part of my super and personally large investment.
Thank you. I think we have run out of time. If we haven't got your questions, we will respond to them directly, but we did get to most with that rapid fire session at the end. Thank you for joining us for this update today. As small cap portfolios go, I think you'll be hard pressed to find one that is more conservatively positioned at the moment. With regard to future webinars or the next webinars in the series, we're taking a break over the holiday period. So our next webinar will be on the 3rd of May with James McDonald, the portfolio manager of the Pengana High Conviction Equities Fund. And you can register for that on our website. Please do. If you have any other questions, please get in touch. We'd love to hear from you. Thanks very much for joining us.
Thank you.